Have you noticed the price of gold lately? It's not just rising. It's soaring to levels we've never seen before, shattering all previous records. As I'm recording this, it has already blasted past $4,300 an ounce. While the news talks about inflation and gas prices, they're missing the real story. This isn't just a market fluctuation, it's a warning sign. A signal that a massive, slow-moving financial catastrophe is unfolding right under our noses, one that could reshape our entire world. Historically, gold has been the ultimate canary in the coal mine. Its value skyrockets right before a major global crisis. We saw it in the 90s. We saw it in 2008 before the financial collapse. We saw it again in 2020 with the pandemic, and we're seeing it now, bigger than ever. This isn't a coincidence. It's a clear indicator that the global financial system is undergoing a massive correction. The big question is, why? What is happening behind the scenes that's making smart money run for the safety of gold? To understand where we are, we need to look back at how we got here. It's a story of a financial time bomb being passed from one hand to another, getting bigger and more dangerous each time. Our story begins in 1998 with a hedge fund called Long-Term Capital Management, or LTCM. This wasn't just any fund. It was run by financial wizards, including Nobel Prize-winning economists. They believed they had created a foolproof system, making massive bets on tiny differences in interest rates. Their positions were so enormous, they reached into the trillions of dollars, all built on complex mathematical models that said they couldn't lose. But then, the unthinkable happened. In August 1998, Russia defaulted on its debt. Panic ripped through global markets. Investors dumped risky assets and fled to the safety of US Treasury bonds. LTCM's models shattered. The fund hemorrhaged tens of billions of dollars in a matter of weeks. The real problem was that LTCM was deeply interconnected with nearly every major bank on Wall Street. Its collapse wouldn't just be the end of a hedge fund. It would trigger a chain reaction that could bring down the entire US financial system. The time bomb was ticking. In a move that set a dangerous precedent, the U.S. Federal Reserve stepped in. They orchestrated a massive $3.65 billion bailout, forcing 14 major global banks to absorb LTCM's toxic debts. The immediate crisis was averted, but the bomb wasn't defused. It was simply transferred. It moved from the hands of one hedge fund into the balance sheets of the world's largest banks. The system was saved, but it was now more fragile than ever. The fuse had been reset for 10 years. Fast forward to 2008. The time bomb, now sitting inside the world's biggest banks, was about to detonate. This time, the trigger was the U.S. subprime mortgage market. For years, banks had been handing out mortgage loans like candy, with incredibly low interest rates and lax lending standards. This fueled a housing frenzy, driving property prices into a massive bubble. But the banks didn't just hold these risky loans. They packaged them into complex financial products called mortgage-backed securities and sold them to investors, pension funds, and even other countries all around the world. They were marketed as safe, AAA-rated investments, but they were built on a foundation of sand. As interest rates began to rise, homeowners started defaulting on their loans. The housing market was suddenly flooded with properties for sale, and prices crashed. The value of those safe mortgage-backed securities evaporated overnight. The dominoes began to fall. In September 2008, the investment bank Lehman Brothers declared bankruptcy, sending shock waves across the globe. The entire global financial system froze. The time bomb had exploded inside the banking sector. Who could possibly save the banks? The governments. The U.S. government and others around the world had no choice but to intervene on an unprecedented scale. They unleashed bailout programs worth hundreds of billions of dollars. To fund this, the Federal Reserve started printing money like never before, a policy known as quantitative easing. This massive injection of cash saved the banks, but it came at a huge cost. The time bomb was passed again. This time, it moved from the private sector, the banks, onto the public balance sheet, landing squarely in the hands of governments. The U.S. national debt ballooned by about $2 trillion, and the seeds of future inflation were sown. The world breathed a sigh of relief, but the underlying problem had only grown larger. The bomb was now in the hands of the lenders of last resort. Then came 2020 and the COVID-19 pandemic. The world shut down. Global trade ground to a halt, businesses closed, and millions lost their jobs. Governments faced a crisis unlike any other. Their only tool to prevent a complete economic collapse was the one they had used in 2008: print more money. But this time, they did it on a scale that dwarfed everything that came before. The U.S. Federal Reserve printed trillions of dollars. To put it in perspective, it's estimated that around 80% of all U.S. dollars in existence were created after 2020. It wasn't just the U.S. either. Governments in Europe, Japan, and China all did the same, borrowing and printing massive amounts of money to keep their economies afloat. This is the critical moment in our story. In 1998, the banks rescued a hedge fund. In 2008, governments rescued the banks. But by 2020, the time bomb had been passed to the governments themselves. It had morphed into mountains of sovereign debt. Now, ask yourself this: when the governments are the ones in trouble, who is left to rescue them? There is no higher entity. There is no one left to pass the bomb to. This is the silent crisis that the mainstream media isn't discussing. And it's the real reason gold is screaming its warning. So, where does that leave us today? The very countries that once acted as the world's saviors are now drowning in debt. The United States public debt has spiraled past an unimaginable $35 trillion. And it's growing at a terrifying rate, about $1 trillion every 100 days. To put that in perspective, the annual interest payments on this debt are now larger than the entire U.S. defense budget. Think about that. We're spending more just to service our debt than we are to fund our entire military. And it's not just the U.S. Look at Japan, historically one of the biggest buyers of U.S. bonds. Their national debt is over 250% of their entire economic output, a staggering figure. Europe is facing fiscal deficits not seen since the end of World War II. Even China, the world's manufacturing powerhouse, is dealing with its own internal economic crises and has drastically cut back on lending to other nations as it tries to manage its own problems. When the world's largest economies, the rescuers of the past, are all in this much trouble, there's no one left to bail them out. This is the core of the problem. This is the final stage. And this is precisely why the price of gold isn't just rising, it's going vertical. It's reflecting a fundamental loss of faith in the stability of governments and their currencies. So, what are the people who know this best, the central bankers, doing? They aren't just watching from the sidelines, they are quietly preparing. All around the world, central banks are on a gold-buying spree. They are accumulating physical gold at a rate not seen in decades. Why? Because they understand the game. They know that government bonds and the US dollar, once considered the ultimate safe assets, are no longer the reliable safe havens they used to be. The system they are sworn to protect is showing deep cracks. The biggest bear on the scene right now is the People's Bank of China. In the last quarter of 2024 alone, China reportedly added over 333 tons of gold to its reserves. That's a 54% increase from the previous year. This isn't just a financial strategy, it's a geopolitical one. As trade tensions with the United States continue to simmer, China is actively reducing its reliance on the US dollar and diversifying into the one asset that has no counterparty risk: gold. They are sending a clear signal that they see instability on the horizon and are taking concrete steps to protect themselves. When the guardians of the global financial system are all running for the same lifeboat, it's time for everyone else to pay attention. The unprecedented gold boom isn't the crisis. It's the alarm bell telling us the crisis is already here. Gold is expected to rise further, potentially surpassing $5,000 and maybe even $6,000 an ounce as this slow-motion catastrophe continues to unfold. Thanks for watching. This is a complex topic, and it's crucial we all stay informed. If you found this analysis helpful, please hit that like button and consider subscribing to the channel for more deep dives into the forces shaping our world. Stay safe and stay informed.